Yeah, as Tim said, we're a leading industrial distribution group. If you could just move to the next slide, please. From an investment proposition perspective, we're a pure play distributor for industrial maintenance, repair, operations and safety supplies. We've had a fast growing revenue and profit profile. Our product group is everyday products, so there's high demand for that in the workplace and for every workplace. We work in a large $40 billion addressable market, and it is quite fragmented, with the largest player owning about 4% market share of that. We've been very deliberate in our business model in terms of our investments, and recent investments, which I'll take you through, are yet to materialise, so that's going to provide considerable uplift in the short to medium term. We've been able to build also competitive advantages. We've got great exposure to diversified end markets, which we expect also to contribute to our financial performance in the short to medium term. All our businesses we expect to grow across all markets and all customer types. From an economic point of view, it's favourable for us, maybe not for other sectors, but whether it be COVID related or non-COVID related products, it's been very robust in that time. Next slide, please. So just about the group. We're a business-to-business distributor as well as a business-to-consumer distributor. We're headquartered in Western Australia, but we operate throughout Australia and select international markets. Our focus in recent times has been back into Australia. We've got 6 operating brands that work in different markets, and now our network consists of 66 branches and stores that are Australia-wide. You can see by the diversified end markets, this is at 31st of December, we cover quite a range of different areas, but mining, resources, contractors is clearly our largest market, but that's obviously been reduced in recent times. The type of product that we sell is for every workplace, and you can see on the right-hand side of the screen that we're quite comprehensive in terms of our products, from tools to workwear to hardware to truck parts and automotive. In fact, we're the only company of our type now as a single source that can provide all those depth and breadth of products. Our sales mix is 87% of business customers, 13% of retail. Retail is also 9% between online, and the balance is walk-in traffic to our stores. Next slide, please. To put that in a little bit of context, they talk about pictures saying 1,000 words. This is a picture of some of our operations, both inside and outside. You can say that we've got, real or physical assets, as well as obviously quite an extensive range of products that you can see within our stores there. That's online, and also on the left-hand side, we put vending machines across a whole host of different locations as well. Next slide, please. So achievements in the last 6 months, we've delivered a record financial result. Our revenue's been up 55%. Our EBITDA, underlying EBITDA, was up about 240%. We've acquired 2 companies, which one was completed in August, the other one completed a week ago, that will contribute new customers, new product lines, and also on an annual basis, an additional 26 million of revenue. We've probably captured about 9 of that so far in the last 6 months. We've doubled the number of store outlets throughout Australia by 38, and that's taken us to 66. We've also, through previous investments, won recent large customer contracts that will deliver $18 million of revenue on an annual basis at its peak. Those contracts are between 2 years and 5 years. They are embryonic, they've just been rolled out, but they're starting to deliver material upside for us. In fact, all the above, for the first time, we may deliver a $10 million sales month this month through the combination of all those elements before. We continue to invest in employees, and that's to attract as well as retain. We do reward our employees, particularly in the current market. We've also generated $3 million of cash, which has helped obviously reduce our debt. But we've only just received those funds in the last week, and that's come from an investment in shareholding in the UK, the business that we had there, a joint venture with Bisley Workwear, and also the acquisition of United Tools. Our capital allocation is light. but it's also deliberate in terms of making sure that in our scale, we've got e-commerce, store upgrades, distribution centres for those new businesses, so we can look at consolidation and maximising the efficiency of our supply chain. Next slide, please. So all that wrapped up, whilst I just showed you 6 months, this is our journey since September 2018, so 3.5 years. So you can see our brands. We've got a really strong M&A record. Recent acquisitions of Skippers and United Tools is significant. We've essentially have a run rate today of $100 million in sales, and that's up from 24 million in September 2018. We're up from 1 store to 66. We've got 1 million products now available, 5,500 odd customers. We have 230 odd staff, but through the independents, it's about another 350 people that work within that, and 2,500 suppliers. So material growth, material scale, material operating leverage is now almost at its embryonic phase again. Next slide, please. And that's allowed us now to create quite a comprehensive distribution chain. So from an omni-channel perspective, we connect from suppliers to customers, thousands of products to all customer types, all sizes, and every industry. So having a supply chain infrastructure with the technology platforms, with Salesforce, click and collect options, with service structures is really key. But more importantly, we've now been able to put an operating platform close to our customers for faster fulfillment. And in doing that, we're now able to match with the large players in the market. Next slide, please. On the right-hand side, that's to give you some context in terms of locations of our network. It's quite comprehensive in terms of market coverage, but what it's also been able to do is from a competitive advantage perspective, we've got a sample of customers there. Some of those customers, in fact, a large portion of them, we only supply in certain geographies. With the acquisition of United Tools, we're able to now expand those services into other regions, which we've been asked to do on a number of occasions previously, and now we've got the platform to be able to do that. Next slide, please. From a board perspective, Chris Wharton is the former CEO of Seven West Media, heavily involved in distribution, worked with Kerry Stokes for about 15 odd years. John Gropley is the former longest serving director of Automotive Holdings Group, which was consolidated into APEs, and he was the acting chair for the last couple of years. And Simon Poiterman, who has a very long history in the capital markets, as well as a former captain of the Wallabies. For a business doing 100 million in its turnover today with a 13-cent share price, we're pretty cheap. Our debt has only increased in the last 15 months, and that's because of the acquisitions that I've just mentioned, C&L, Skipper Transport Parts, and United Tools, obviously. We have a bit over $4 million worth of cash. Our revenue, as I mentioned, is increased 55% to 44 million, and whilst our profitability is only 1.7, we have a target of 8% EBITDA in 2025. To grow and do what we've done over the course of the last 6, 12 months, and also 24, requires investment. So we've continued to invest for the future. We've got a really nice balance in our shareholding register between directors and management. I'm the largest shareholder. We've also been well supported since our IPO from institutional investors and some high net worth individuals. Next slide, please. So our trading performance, as we kicked off in the second half, really strong demand for our product. As I said, we are likely to hit a $10 million sales month, which is a new record for the company. The 35 new stores that are coming from United from a week ago will deliver significant opportunity for buying power and leverage in the future, which allows us to grow organically. We're clearly focused on margin expansion as well as integration, the synergies of those acquisitions. The pandemic and economic situation, whilst it's dynamic in a few different industries for us, We haven't missed a beat, and the fact that we've been able to deliver almost a 10 million a month just shows that. We have managed our supply chain well. We did increase our inventory by about 14%. Some of the categories do have some slight delays, but that hasn't stopped our business. Next slide, please. So a vision in terms of looking forward, as I mentioned, we're really looking to connect our products and solutions to every workplace, every industry, and also residential. We want to be the market leader. Our strategy is about business combinations, organic and M&A growth. We want to be the best and biggest in terms of industrial supplies at the best prices, and also giving the best industry experience. We're building a large ecosystem of company-owned assets and also independent retailers, and we're doing that because it's a capital light model, but obviously we can go to head-to-head with industry giants. Next slide, please. We're clearly focused on shareholder value, so investment, performance improvement, cash generation. Our organic growth and our acquisition model is consistent. Our margin expansion is that we expect to grow by 25% year on year for at least the next 2 to 3 years, and our target remains consistent with previous announcements that we've made. Cash is important, operating cash flow as well as active portfolio management, meaning the turnover of our inventory is a key focus as well. Next slide, please. That all drops into, I guess, what are the value levers, which I've covered in terms of our priorities from 1 to 6. Our investments in the future will continue, and it's consistent around products and infrastructure and people, as well as our technology and supply chain. The key drivers are really about expanding our products and our services and our network, and making sure we're the market leader, and continuing to grab opportunities as they arise. And next slide, please. So just finishing, it's a wrap up of really what I've suggested. It's a really exciting period for us to capitalise on the synergies, acquisitions, looking at further acquisitions as well. But there's a lot of organic growth opportunities that sit with us. We've got long-standing relationships with suppliers and customers in a large fragmented $40 billion market. Our new scale is powerful. Our distribution platform means that we can deliver services and products that no one else can from a single source in our marketplace. We expect to deliver strong financial returns in the near future. We do have a solid balance sheet to be able to support organic growth. We expect to grow by 25% year on year. And lastly, our target of 8% EBITDA is very realistic. Our peers are generating internationally, which we focus on and watch closely, between 12 and 14%. So clearly, as we advance our business in the long term, we feel that that's absolutely an achieved target. So thanks, Tim.
Thanks, Mike. We should remind the audience that I believe you've got COVID at the moment. So another example of a very committed CEO. So thanks for your time.
Yeah, apologies about that in my croaky voice.
Yeah, a little bit croakier than normal. But in terms of the business model, for investors looking at this for the first time, is kind of that Metcash business model a good comparative, direct to consumer, business to business? Is there any lessons to learn from that sort of business model?
It's exactly what it is. Metcash, almost a Metcash IGA principle, or Metcash Mitre 10. Clearly, to grow as fast as you can, we need the support of independent retailers, and the major players obviously are Wesfarmers and Metcash. The gap between them and everyone else is quite significant. We feel that we've now positioned ourselves in the middle of that, particularly as the only player. But our depth and breadth in terms of our ability to be able to support the independents, but also grow with our company operations, allows us to be able to provide a genuine alternative to the market. And we're finding that a lot of organisations like dealing with us because we're agile, we're nimble in our decision making. We're also very keen to invest and work with our customers. So we're evolving our business to work directly with them. And in doing that, we're seeing the benefits of upside.
And so what's you've made a lot of acquisitions. What's the underlying kind of organic growth rate, I suppose, in your business and kind of the key drivers?
It varies. So in our Queensland business, it's grown by 33% at the top line and a bit over 40% at the bottom line in the last 12 months. Heatley's business we acquired with a revenue just under 40 million, and that's doing closely high 50s now. So obviously double-digit growth from an organic perspective year on year. The Skipper Transport business, which was more complicated than previous acquisitions, is flatlined, but we expect significant upside because it's geography, particularly in the Pilbara regions, whereby mining, oil and gas, and gives us the ability to sort of penetrate that market with a comprehensive range of products.
And Mike, there's several more questions I'd like you to answer online if you have time. Can you just give us a little bit, and we'll finish on this, just a little bit more colour on your current market position and the opportunities to grow by acquisition and to further consolidate the industry? Big question, I know.
It is. Look, I saw this probably 15 years ago in the logistics market. I feel that there is consolidation. The big players are getting bigger and the small players are finding it hard to compete. So we feel that we've got a genuine position there. Maximising the opportunity of that is about, the integration and delivering a one distribution platform and leveraging, I guess, the investments that we've made over the last 3 years, but particularly in the last 12 months. So we see organically 25% at least growth internally. From an acquisition point of view, we are active, we are always looking, but it has to be value accretive. So previously, the acquisitions we've taken have been less than 3x multiples. The last acquisition, we actually took on $1.4 million of cash with a repayment over 2 years, and that business has the opportunity to sort of triple its revenue from 8 million in 24 fairly quickly. So I guess we're going to continue on that mandate of organic and M&A growth, but clearly we need to make sure that we maximise the opportunities that we've created within our own organisation over recent times. And there's a lot of synergies that sit within that on a revenue perspective and also from a margin uplift.
Right, Mike, that's all we have time for. Hope you're feeling better at some point. There's some questions to answer online if you have time. Nice to see you.
Thanks, Nick.